Hey everybody, so I'm back again. I went live a few minutes ago, and it was like I was blowing into the microphone. It was like I was yelling into the microphone, which was kind of super rude of me. And I figured I went
Sorry,
live.
I can't just like that music for you.
I gotta. Every time I say a word even remotely similar to Siri, the pod just starts responding to me. Anyway, I went live on the tubes a few minutes ago, and it was like I was blowing into the microphone much too loud. And so I thought I would redo that. And we could talk about the Australian dollar because the Australian dollar is sort of the canary in the coal mine. And I feel like I'm about to repeat so much of what I just said that many of you are going to unsubscribe to the channel, which is fine. That's perfectly fine if you want to do that. However, don't, because I'm about to share some stuff I think is super important. And I think there's some bearishness creeping into the market. I feel like I'm repeating myself again because it just went live and I said all this stuff. But let's just go ahead and take a look at some charts because the Australian dollar went overbought. There's this indicator I have been working on with a friend of mine, Markay. You probably saw me send 9,000 emails about her new service, which is super cool. I think it's only open for the next few hours. But anyway, that's a profit zone. That red line scrolling up and down on the chart there is a profit zone. That's an indication that the market wants to turn bearish. And what's hilarious is in an extremely insane, ludicrous bull market that never turns bearish. Let's say, for instance, when, I don't know, a central bank prints $4.5 trillion of free money for banks, the market goes up anyway, even if the fundamentals of the economy are kind of weak or shaky or whatever. And the Australian dollar is an interesting canary in the coal mine for all of this stuff. And it went overbought like a billion quadrillion years ago. And it's one thing for the Australian dollar, US dollar to go overbought. But it's a whole other thing for the Australian dollar, Japanese, that's how you say mayonnaise in Japanese. It's another thing for it to go overbought. Like the Australian dollar, Japanese yen is super highly correlated. I'm just pronouncing it phonetically. It's highly correlated to the S&P 500. The Australian dollar, Japanese yen, in fact, often will lead the S&P 500. So if you just compare the S&P 500 with the Australian dollar, Japanese yen, a lot of times what will happen is the Australian dollar, Japanese yen will go into Tesla launch mode, but the S&P 500 will just sort of dilly-dally along for a bit and then catch up with it way later on. It will rapidly catch up with it. And there's a reason for this. So what happens is, I've explained this in the past, but I think it bears and is worth repeating. What happens is, so in Japan, interest rates have been zero for like, I don't know, 20 years, right? The lost decade from 2000 to 2010, where they had stagnant growth, super low interest rates. They spent trillions of dollars on infrastructure, but they couldn't really get the economy moving because nobody was having the sex and making the babies. And so everybody in Japan was getting really old. And when everybody in your society is getting old, nobody wants to work at McDonald's anymore, and nobody wants to work anywhere anymore. They just want to retire. They want to sit back, retire, and have their... I don't want to make any cultural stereotypes here. I've already feel like I've gone too far on this. They want to sit back and they want to enjoy a Kirin Ichiban #1 beer, and they want to just hang out. What's the name of that alcohol from Lost in Translation? Anyway, the point is, interest rates were so low in Japan for a long time that you could borrow money in Japan, and you would borrow money in Japan at like 0.25%, like 25 basis points. A mortgage in Japan, which is not really a mortgage, that's a complete tangent that we don't need to get into. Anyway, at 0.25%, you could borrow the money in yen, you sell the yen, you buy other financial instruments that have a greater return. And so you had this carry trade. And a lot of people think the carry trade is dead because interest rates around the world are basically at zero. But the carry trade isn't dead. It's still really cheap to borrow money in Japanese yen. It's still super cheap. So you borrow in yen and then you invest in places where you think real estate or the stock market or, I don't know, illicit drugs or whatever it is that you're into go up. And so that's what happens. That's what happens when the Australian dollar Japanese yen is going up. What's happening is people are borrowing yen and buying Australian dollars. That's what they're doing. They're selling yen. They borrowed them, they sold them, and then they bought Australian dollars. And then they just, when the Australian dollar Japanese yen goes up, they can sell their Australian dollars, they can pay back their loans, and what they've done is they've paid back the loans in a devalued currency. And it's just like a proxy for all of the other ways that the yen is used. Anyway, I summarized a bunch of stuff that's probably not completely accurate, but I got the basics correct. And so what happens is the Australian dollar Japanese yen will skyrocket, and then the equity markets will often then catch up. And sometimes the equity markets will catch up, and they'll play catch up, and they will overextend. And you can get a look at that, like that overextension. You can get a really good look at that when you look at something like the IWM. So the Russell, it just, so I changed the wrong instrument here. I want to change the one that's being compared. The Russell just is out of control. It's overextending itself. It's pole vaulting and hitting the ceiling of the stadium. It's absolutely out of control. And the Australian dollar Japanese yen, once again, let's go back to what we said earlier. It was overbought like 2 weeks ago, or a week ago, whatever. I can't tell time or dates. And I have a tenuous relationship with the time-space continuum. So let's take a look at it here. So this is the IWM, which I wasn't sharing before. I'm sharing it now. So that's the IWM. It's super overextending itself. The S&P 500 is doing something very similar. But what's happening now is the Australian dollar Japanese yen printed an overbought signal like on the 25th of May, and things still haven't moved down. It just climbed from there. And now what I want to do is remove the comparison, and I want to just draw the trend line. What I would look for now is a break below a trend line here. And if that trend line break happens on the Australian dollar Japanese yen, guess what the Australian dollar Japanese yen is going to show you that the market wants to do? It's going to show you that the market wants to tank, that it wants to correct, like the S&P 500 and the Russell and all those other equity markets that seem to be, or appear at least in theory, to be a little bit overextended. So let's also do something I never do, which I think is insane. It's like absolute voodoo science. It's the fib stuff. So I wouldn't be surprised if we get an Australian dollar Japanese yen correction that corrects to a 23% retracement, goes down to like 72.75, like 400 pips lower, and that this 800 period simple moving average, this blue line on the chart, rises up a bit to meet it a little bit. I wouldn't even be surprised. I would not be surprised to see it get down to 70. That's a really nice round number. And I bet that's an area of historical significance as support and resistance. So I'll make this line really thick. Hey, if you ever are worried that your stop loss is going to get hit, you just increase the thickness of the line on your charts, and then it has trouble breaking through it. So you can see that it banged up against this support and resistance level, back in February. And I wouldn't be surprised if we went out further in time. There we go. It doesn't surprise me at all. Look at this. Support and resistance is magical. It's magical. It's magically delicious. It's like the technical analysis equivalent of Lucky Charms. There it is. That 70 level is delightful, and the market wants to go to that 70 level. And I think it will. And I think if it breaks below the trend line and it breaks below 75, I think what's going to happen is it's a cascading effect. It's a domino effect that then brings the rest of the markets with it. Okay, that's all I have for you on Sunday night. I just wanted to give a little bit of a market preview here. I wanted to say hello. I sent you 9 quadrillion Sales related emails last week. Markay's 52 trades to retirement is amazing. I sent you 500 million emails about it. I think you should check it out. I think it's going to come down tonight anyway. But for all this week, I kind of want to back off of that kind of stuff, and I want to sort of push out a bunch of really interesting content and analysis. We should spend more time doing support and resistance stuff on the charts. It's really simple. It's really easy. Once you master that, I think it's really the only indicator someone ever really needs, along with maybe Knoxville divergence, which it's also bearish divergent. If you want Knoxville divergence on your trading view charts, you just go to the indicator button. Let's go here. So there's an indicator button on trading view up at the top, and you click on it and it brings up these indicators and strategies. And then, like I told you earlier, you just type in sexiest man alive. Oh, it doesn't come up anymore. Okay, most interesting man in the, that's not coming up either. That's really interesting. Regular guy. Wow, it doesn't even come up. You just type in Rob Booker. And then what you do is you click on Knoxville divergence, and then it shows up on your screen. You can double click it and change the bars back to 30, RSI period to 21, and the momentum period to 20. And it will show you early warning signs of when the market wants to turn. And a bunch of stuff is divergent. I don't know if the 4-hour S&P 500 is divergent, or the 4-hour IWN. So look at that. The Russell is not only at the 800 period simple moving average, which I feel like is a big deal and a level of resistance. It's bearishly divergent. It's also magically bearishly divergent. It doesn't mean it's going to fall. It doesn't mean that. I think it's going to fall. So on Friday, I bought puts. So I made a bet on Friday that the market's going to drop a bit. I don't know where things are, sort of shaping up pre-market, but we'll check that out in the morning. Maybe I'll go live again on the YouTubes here and say hello to you all. Thanks for joining me here on a Sunday evening. I'm not really even sure that any of this even worked. So I hope you enjoyed it. Thanks for subscribing to the channel. Thanks for hanging out with me for a few minutes. Thanks for watching this entire video again, because the microphone sucked badly on the first go round. And I'll see you tomorrow sometime. Bye for now.